Well, it was a budget of great expectations, and we largely got what we expected. The announcements that were made were either very well trailed or very well anticipated, but at least we know what we're dealing with now. We also know that there will be some further consultations issued, as I mentioned before, on the 23rd of March. So something to look forward to. So the background to the budget, we all know, was heavy government debt and a commitment to, at the right time, very important, at the right time, repair public finances, reintroduce fiscal conservatism. So what are we dealing with? What did we know today? What did we get to know today? Well, to remind myself, at the end of what already seems like quite a long day, I'm going to have a quick look at the iPad, and it's a three-part plan. Of course, the Chancellor started with a three-part plan, a commitment to continue to do whatever it takes, and he did, I think, to support the economy, jobs, people and businesses, fixing public finances, but in an honest, open way, and third, beginning the building of our future post-pandemic economy. So for the financial planning sector, for us and our friends, what was said that is of interest to us, direct interest to us? Well, definitely the expected freezing until April 2026, based on 21-22 rates of allowances, exemptions and thresholds for income tax, for capital gains tax and inheritance tax. We also had, and there was some relief around this, but also well trailed, the extension of the furlough scheme through till September and the extension of the self-employment income support scheme through till September, with some adjustments made after June. Employers under the furlough scheme having to contribute a bit towards that 80% payment that employees on furlough will get, and that contribution will be made from July. Okay, more self-employed will, however, be able to apply, it seems, subject to satisfying the other conditions, for the self-employed income support scheme if they submitted a tax return for the 2019-20 year. And that is a first, because for the other grants up until now, it hasn't been possible. So first time for a 2019-20 submission for a self-employed income support grant. I think you can make those from April, and then there'll be another grant later in the year taking us through until September. We've got the extension of the SDLT cut. I know one of my colleagues is covering this in more detail, and of course the mortgage guarantee scheme. A freeze of the lifetime allowance, another one of my esteemed colleagues covering that around pension planning and the freezing of the lifetime allowance. Then we have, and this was also well trailed, the proposed increase to corporation tax, but not until 2023. And when we do get to 2023, 1st of April 2023, which is when the corporation tax year starts, the rate will go up to 25%. But wait a minute, only for profits that exceed £250,000. So the 19% rate will hold good for any profits up to £50,000. Once you get above £50,000, there will be a sliding scale, which hasn't yet been made available to us, but a sliding scale that will take, in the marginal relief area, your profit tax rate up from 19 to 25%. You're thinking, have we been here before? And I'm answering, yes, we have. So we'll be dusting down our marginal relief ideas, and we'll be definitely looking at the remuneration strategy, taking into account dividends or salary when the corporation tax rate has jumped up as high as it has. But we've got a bit of time to do that, because this doesn't apply until 2023. Also for businesses, importantly, we have a special loss carryback provision. You know, there's an unlimited carryback of unlimited losses for 1 year. Now it's been extended for trading periods ending after the 1st of April and before the 31st of April 2020, and before the 31st of March 2022. In that period, if you submit a loss claim, you can carry it back up to 3 years, but for losses up to £2 million, which for most businesses will be perfectly high enough. I think also there is a new, what are they calling it? A super deduction, not a super spreader, a super deduction for companies on qualifying capital expenditure. This super deduction will allow companies to cut their tax bill by, it's basically giving you 130% relief on your expenditure. So it will allow you to cut your tax bill by 25p for every £1 you invest in a qualifying investment. Because basically it's 19% plus 30% of 19%, which is roughly 25%. So they are the main changes that I saw of relevance to the financial planning sector. And we're all maybe not holding our breaths, but certainly awaiting with interest the further consultations on the 23rd of March. Let's not forget, in the meantime, quick reminder, we are heading towards the end of the tax year. Let's also not forget the end of the tax year this year is in effect the 1st of April. So let all that sink in. If you want it to sink in further, do have a look at our Techlink Bulletin, which will be published shortly, covering all of those changes in a lot of depth, and of course all the follow-up to those changes, heading towards the consultations on the 23rd of March. Happy reading.